Hello and welcome to Africa Business Weekly. I'm Aki Obake. Alongside my colleagues Tabitha Mutoni and Keyamo Mosepele, we'll bring you latest developments shaping Africa's business landscape. But let's get a sense of what to expect on the show today. Keyamo is on standby to give updates from Southern Africa.
Thank you, Akin. Nedbank expects Mozambique's economic growth to pick up to 2.5% this year from 1.9% in 2024, which was sharply lower than the expansion of 5.4% in 2023. With LNG projects restarting, inflation easing and political stability improving, the big question now is whether the recovery can gain momentum. For more, CNBC Africa's Fifi Peters spoke to Isaac Mashego, senior economist at Nedbank.
Expect the Mozambican economy to pick up, particularly in the second half of this year. This week, we saw the first quarter numbers showing a contraction of almost 4%, and that was clearly, the lingering effects of the political instability in the final quarter of last year, and of course, a less favorable global environment. But of course, we've seen some very encouraging developments, particularly the announcement that the construction of the onshore LNG field will likely resume around the middle of this year, which is about now. And we believe that will be a very key contributor to the recovery of the Mozambican economy.
Mm-hmm. So I assume you are talking about one of the projects in which Total Energies is involved. They plan to start their $20 billion onshore LNG project in July, according to the company's announcements. You say that it will be key for Mozambique's medium-term economic growth prospects. I suppose maybe just flesh out the detail in a scenario that everything goes according to plan. What could the economic metrics potentially look like?
Sure. Construction will be the key beneficiary. We'll see an inflow of foreign exchange. We know that the foreign exchange market has been quite tight lately. And of course, the offshore field has continued to expand its output. So that is going to boost exports, and we believe that with the improving political situation, President Chapo has gone far enough to ensure that political stability is restored, and we believe that growth could be closer to 3%. By the way, 2.5 seems to be our low end of our forecast range, and we believe that growth will pick up even further in 2026. ExxonMobil will likely reach its final investment decision by the end of this year, could be early next year, and that will mobilize more foreign capital into Mozambique.
On the forex squeeze that you did allude to, maybe you can also just unpack for us some of the pressure points driving it, and I suppose what needs to change for the situation to improve.
Sure. At least from our guys on the ground, that is the Nedbank Mozambique, what we hear is that, liquidity in the banking market, and I'm talking about foreign exchange liquidity, has been tight. That, unfortunately, has impacted some business operations, and the political instability in the fourth quarter of last year did add to those pressures. But we've seen the Bank of Mozambique taking action to help to ease those foreign currency pressures. They've lowered their reserve requirements on foreign currency deposits, and there's some indication that the Bank of Mozambique is providing some liquidity into the market. So with the higher foreign exchange liquidity, like for instance, importers will be able to purchase basic goods that go into the production process. Miners will be able to import, the machinery that they need, and that will overall boost economic output.
With the first half of 2025 being marked by volatility, the need for insights to navigate the way forward cannot be understated. Lower inflation and monetary easing offer South Africa's economy relief, but trade tensions, high debt burdens and geopolitical risks cloud the outlook. To discuss everything from trade wars, the GNU, and local reforms needed in South Africa, CNBC Africa's Nastasia Arendse spoke to Gina Skuman, Managing Director at Citi.
At the beginning of the year, we saw global growth coming in at just over 3%, about 3.3%. Since then, everyone has downgraded that, around about 2.8%. But there's still a lot of trepidation because, of course, this is only the first half of the year, even though it feels like a lot longer. We've still got the second half of the year, and as you mentioned, the 9th of July coming up. For South Africa, this is the sad state of affairs. We were very much just under 2% as a growth forecast for this year when we started the year. We got some data from last year that pulled that down, but we're currently sitting on a growth forecast for South Africa this year of only 1%. And that's something we actually moved to about 2 months ago. We've since seen the consensus come down to 1.2. I think the BER out of Stellenbosch has also come down to 1%. So you can see that crowding down to that much lower growth number, which is it's insufficient and in a very sad state of affairs.
When you look at the economy as a whole, where are the pockets of weakness for you and probably even the areas of concern?
Biggest for us is definitely investment, and particularly from the private sector. So we had moved down to 1.2% growth, but when the Q1 GDP numbers came out, we pulled that down further. The private sector fixed investment numbers are really awful. And it does correlate with the business confidence, or should I say the lack of business confidence, that we just aren't seeing in this economy. And this brings a massive question mark into the picture. Because yes, we get a bit of load shedding, but if load shedding is not like it was, and it's largely out of the way, and there are other reforms going on, then what is holding back private sector investment?
It's quite interesting, and I'm glad you brought up aspects around the reforms. So before we get to that, let's talk about that GNU optimism, because it's all we spoke about from July up until last year. And it's almost as though if you do like a 1-year analysis, it's like a tale of two halves. Absolutely. Which half are we in right now versus the half from last year?
Well, I guess where South Africa got really unlucky is that the second half of last year was the honeymoon period. It was the relief. And, South Africa typically runs like this, off euphoria, and we unfortunately run too high. And at the start of this year, we saw the first cracks starting to show in natural disputes that would arise between two of the biggest parties within the GNU, the ANC and the DA, on things that they've actually always disagreed on. But then the backdrop behind that of Trump started to emerge as a geopolitical risk. And so the first half of this year for South Africa, never mind the geopolitics and the trade wars, we had this risk premium that started to rise because of local politics and because of US-South Africa politics.
What's quite interesting is that we've been talking about reforms quite a lot. We had Operation Vulindlela 2.0 as well that was launched. And I'm sure many people are asking what is happening on the reform side and why that's not translating into growth, because as you touched on, the load shedding part seems to have abated somewhat. Where are we when you assess the reform agenda?
I have a lot of empathy for those who are pushing the reforms, and it is a joint collective group of individuals. It's not just Operation Vulindlela out of the presidency. You've also got the private sector helping out. You've got the BER in Stellenbosch, also now an arm of that. I don't think we appreciate for some of these reforms the amount of back work that needs to be done. Transnet, rail, ports. There probably is a lot more going on that you can't see by simply plotting railway volumes, which at least have improved. But it's a very big ship, no pun intended, to turn around. Eskom, we have seen the fruits of renewable energy, and certainly those power outages have receded in a very big way. But everyone is very aware that there is still another phase of Eskom transmission that has to occur. So this isn't just about fixing what's necessary now. This is looking forward over the next 10 plus years, especially if you're a private sector investor and you want to put capex in the ground and get a return on that.
And those were some of the major stories driving Southern Africa this week. It's back to you, Akin.
Thanks, Kiamo. Now, Tabitha, bring us up to speed with stories from your region.
Hello, Akin. This week, East Africa's finance ministers tabled their budgets for the 2025-26 fiscal year, triggering widespread public debate and scrutiny. But first, let's go down to the DRC on matters of health. President Felix Tshisekedi unveiled a national plan to eliminate pediatric AIDS in the DRC by 2030, backed by an initial $18 million investment, a move that also raises a bigger question of whether this health intervention can be scaled into a sustainable platform for long-term economic growth. I spoke to Dr. John Ditekimena, Regional Director at the Elizabeth Glaser Pediatric AIDS Foundation from Kinshasa, for more.
The Elizabeth Glaser Pediatric AIDS Foundation, along with other partners such as UNAIDS, UNICEF, WHO, National AIDS Control Program, and multi-sectorial National AIDS Control Program, have been working to support the government of the DRC in ensuring the sustainability of the national HIV response. And this presidential initiative is the outcome of sustained effort and strong advocacy aimed at streamlining the country's HIV response. So, as you said, 18 million is a kind of catalytic fund mobilized by the president of the DRC. And the main objective of this initiative is to ensure political commitment from all the provincial governors to allocate a portion of the provincial budget to the health sector with a specific focus on HIV, including pediatric HIV. As I can say, a draft of the final declaration is currently being developed, and we are involved in supporting this. It includes a significant point, such as aligning with the Abuja Declaration at the provincial level, with the commitment to allocate 15 of the provincial budget to health sector, and 20% of those health budget to HIV program, emphasizing pediatric HIV. So in addition, public-private partnership are being also explored as a very important element to bridge the gap for this issue.
Yes, and Dr. John, we also see that only 49% of HIV positive children receive treatment versus 90% of adults. Let us address the root causes of this disparity and some of the targeted strategies that you're likely to see or are being deployed to close this gap from where you sit.
Thanks very much, Talita. This is a very important question. Pediatric HIV treatment in the DRC has historically lagged behind adult treatment due to a combination of systemic, logistical, and social challenges. And key factors include, for instance, limited early infant diagnosis. For instance, access to early infant diagnostic services remain limited, especially in rural and remote areas. Without timely testing, many of HIV positive children are not identified and therefore can be linked to care. The second element would be the stock-up of limited formulations. Pediatric-friendly antiretroviral formulations have not always been available consistently, and supply chain issue and the limited procurement of age-appropriate medicines have further constrained access. And the last one that I can say is a weak link to care. Even though children are diagnosed, the system to ensure they are returned in care and promptly initiated on treatment are often weak, with a gap in follow-up and support for caregivers. And stigma also can be added on the list. Sometimes caregiver may be reluctant to seek testing or treatment for the children due to stigma, fear, or lack of information about pediatric HIV.
Zooming out to the region, East African finance ministers presented their national budgets outlining tax and spending plans for the 2025-26 financial year. We spoke to a range of analysts for insights. Here is more.
Considering what happened last year, because we all know that the Finance Bill 2024 was thrown out and was eventually revoked by the president. So I think they've been very careful and very cautious in making sure that they don't repeat the same mistake that happened last year. There are no major changes to taxes, but I think there's a lot of focus on bringing in efficiency in government and looking at the expenditure side of things. We were with the Honorable Body last week as well, and the one important message was that they are going to be very realistic in terms of their budget preparation, and realistic in the sense that they're going to be realistic in terms of revenue numbers, and they're going to be realistic in terms of expenditure and bring in efficiency. And of course, making sure that the public debt, which is a big concern to everybody, is sustainable in the long term.
I just want to get your immediate thoughts as well in regards to what has struck you so far. I know the speech is still underway as we speak, but I just want to get your quick analysis so far.
From listening to the new CS for Treasury, you note that he says that the budget is more looking into what the people said in form of public participation. Actually, his opening speech, he said that the budget speaks to the right of the Kenyans. So we have seen that they have taken into account what the people have said. As said, you note that, of course, from the protest, people are not willing, or rather, we don't look to having higher tax rates. We also have concerns around the use of public resources. And as said, you find that the budget is more prone towards fiscal consolidation, as well as reducing, or rather ensuring for tax revenue collection. There are no new tax measures, and there are no higher taxes. So, to his word, he seems to have listened to what the citizens have said, and also from what happened last year. So it's a budget that seems to be for people, and we hope that it will be implemented to the later.
Let me bring in Alpesh back. It is an interesting budget coming on the backdrop of protests as we speak right now. We do understand the various groupings within the Central Business District. And we've seen over the last couple of months, the government indicating that they will not be introducing any new tax measures in this budget. A conversation that has, of course, been a hot subject of debate for many people within Kenya. But looking at the stance by the government saying that they will not be introducing any major new taxes, how clear is this for the common man on the streets?
The key message from people we hear from the streets is, yes, the economy may have grown by 4.7%, and the Cabinet Secretary also said that on average we've grown by over 5%. I think the main concern is that the growth is not trickling to the local wananchi, and that's a big concern. And the inequitable gap between the rich and poor is widening. So I think we need to bring in measures as to how we can reduce that inequality. And at this moment in time, of course, the economic policies, the monetary policies, Kenya's economy is very, very stable. Interest rates are coming down. The exchange rate against the US dollar has been very stable for the last 8 months. And I think the key issue, of course, is by not increasing taxes, they're trying to make sure that the cost of living is managed as well. And of course, also trying to make sure that there is enough disposable income in the people's pockets as well, so that the economy can continue to grow. So I think that's a message that the government is passing on to the local wananchi, but it's only time will tell whether that message will be passed through and we will see a growth in the economy that they want to see.
Plenty for East Africans to digest as governments balance growth with fiscal pressures. Our curtains close here. Back to you again.
Many thanks there, Tabitha. Meanwhile, heightened trade tensions and policy uncertainty are expected to drive global growth down this year to its slowest pace since 2008, outside of outright global recessions. Now, that's according to the World Bank's latest Global Economic Prospects report. Growth in sub-Saharan Africa is projected to strengthen to 3.7% this year and average 4.2% in 2026, on the expectation that external environment does not deteriorate further. Phil Kenworth, Senior Economics Prospects Group at the World Bank, unpacks the report.
I think maybe the easiest way to understand our forecast this time round is to contrast it with what we said in January. So back then, we thought that the global economy could be on track for a soft landing. Growth was stabilizing, inflation was coming under control. Unfortunately, since then, the situation has substantially darkened. And really, the global economy has been hit by two large shocks. So the first thing is that we've seen a really dramatic rise in policy uncertainty, at times paralyzing uncertainty. And when uncertainty is at these levels, what happens is that firms and consumers just sit on their hands. If you can avoid making an economic decision, you will do so. And that really hits investment, and that slows growth. At the same time, the second shock, we have seen a historically significant increase in trade barriers, and that will weigh on exports directly, will weigh on trade growth. That also weighs on dynamism and reduces growth overall. When you put those things together, that gives you our global forecast for growth of 2.3% this year in 2025. Now, to put that number in historical context, that would be the weakest growth since 2008 outside of outright global recessions in 2009 and 2020. So we are not forecasting a global recession. It's important to say that. But nonetheless, this will feel like very weak growth indeed for the global economy.
And talking about how the scenario gets near term, now, in terms of your key recommendations to policymakers and authorities, especially at a time of rising trade barriers, what would be the major recommendations?
So look, this is a profoundly challenging situation for developing economies. You know, trade has really been a driver of dynamism and productivity and of rising living standards for decades now. And if we look at the situation today, really it's encapsulated in our global trade forecast. We're expecting global trade to fall to 1.8% this year, so roughly cut in half from 3.4% last year. So this is a really serious challenge. So what can policymakers do? Well, developing economies can really, there are steps they can take to control their own destiny. So, for example, you can lean into and invest in regional trade agreements and deeper bilateral trade agreements. Not everything needs to be about trade with advanced economies. Policymakers can also take steps to boost trade in services, because really, you know, services trade is where it's at. Services is what is driving global trade now, and many of these measures that we're seeing, these concern goods trade, not services trade. The final thing I would say is that policymakers can take steps to improve physical infrastructure, improve logistics, and improve logistical regulatory frameworks at home, and that will reduce trade costs domestically. Because really all of this at the end of the day is about reducing trade costs and therefore boosting trade, boosting productivity, boosting dynamism. So there are plenty of steps that policymakers can take to control the controllables and boost growth at home, even with this challenging external environment.
In terms of how much pressure we should also expect, looking at a global picture for inflation as well, how much pressure tariff increases and then the tight labour market inducing at this moment, and what does the picture look like near term for inflation? It still remains sticky.
Yes, that's correct. So the inflation picture globally is somewhat nuanced because we're starting to see different trends emerging in different parts of the world. So last year we expected inflation to pretty much come under control this year. In our forecast for this latest edition, we've essentially pushed out that point when inflation comes back to levels broadly consistent with targets by another year. So we expect that it will take until 2027. But underneath the hood there are some regional differences. So the increases in trade restrictions and tariffs, we expect that to feed through to increased price pressures in advanced economies, particularly the United States. At the same time, for emerging market and developing economies, these global trade tensions represent a demand shock. And by pushing down demand, that will reduce price pressures to some extent in these countries.
And in other developments, Fitch Ratings forecast Nigeria's Islamic finance industry is likely to expand in the second half of this year to 2026 on the back of increasing sovereign sukuk issuance and Islamic banking assets, driven by new paid-in capital requirements and regulatory moves to develop the industry. Bashar Al-Nattar, global head of Islamic finance at Fitch Ratings, discussed the findings in this report. Take a listen.
The starting point is the positive side of the story, which is we do expect expansion. And the expansion is driven by both of fundamental key driver and also initiatives by the government. So it's a mix of a top-down and a bottom-up. Maybe let me break this a little bit. So the government has issued sukuk, and they have been issuing sukuk previously. And that is something that is important not only to issue sukuk, but it's part of the establishing an ecosystem for the Islamic finance industry in general, which includes Islamic banks and non-interest banks or other participants in the market. That has been taking place, although not regularly, but it has been there. Secondly, we've seen introduction of new tools that allows non-interest banks or Islamic banks to manage their liquidity. And that has been one of the limitations that the Islamic finance industry is facing. Now, if we look at when we say Islamic finance industry in other countries or in more developed countries, we usually talk about 5 segments and pillars within that, which is the Islamic banks, sukuk, which is the Islamic bond market, takaful, which is Islamic insurance, then the Islamic fund management industry, and corporates. In Nigeria, there are actually the biggest 2, almost 50-50. It's between the Islamic banks and the sukuk industry. So it does not have all the elements yet. But it has a significant Islamic Muslim population that is unbanked. So the actual potential for growth is there. Now, that has been there for some time. We've seen any additional steps taken by the government, whether in the regulatory framework, as I've mentioned, and whether in issuing sukuk, that could support the growth of this industry further. We've seen growth in this industry. So currently, the Islamic banking industry in Nigeria is around 1.7% of the banking system. Not much, small, but if you compare it to 1 year back, it was around 1.1, 1.2. Yes. So there is growth, but still from a small base.
And talking about how small the picture is right now, the expectation is that the market share is likely to reach about 2% in medium term. But if we were to look at crossing some of the challenges, lack of awareness, limited product availability and distribution channels, the still developing regulatory framework, how much more work needs to be done to be able to scale these solutions? Because at the end of the day, we've seen the oversubscription recorded. Take, for example, sukuk bond issuances. This definitely shows there's appetite for this. And when we also look at what is being deployed, infrastructure, these are the heart of Nigeria's next trajectory. But for you now, how should the country also position in terms of taking opportunities with this non-interest banking space?
As you mentioned, there are fundamental limitations and challenges. Some of these relate to Islamic finance itself, and some of it relate to the status of the market in general. And by that I mean the status of the debt capital market and its development, and the status of the banking industry in general. Not talking Islamic finance, but in general. So the penetration rate and the unbanked population, although it represents an opportunity for growth because you have a significant unbanked population, but it also shows you that the status of the growth and the development of the banking system. The debt capital market and the stories related to Islamic finance in it and have the right infrastructure to allow it also to prosper is also needed. So if you again look at that, you will find that, as you correctly said, you need to have an infrastructure that allows bankability, whether Islamic or non-Islamic, and then go the extra mile to have the right instruments and the right infrastructure to include the Islamic finance industry in the banking.
And that's all we can take on this episode. You can catch all these stories and more on our website, and that's on cnbcafrica.com. Thank you for joining us. Until next time, stay informed and stay ahead with Africa Business Weekly. I'm Akin Obakeye, and we'll see you again, same time next week.